down to the floor show traders, Teddy Weisberg and Tom Hayes. Tom, I want to start with you. Tell me where you see the best places to be salting money in stocks at the moment, knowing what we know, 6 more rate hikes this year.
Yeah, no question, Liz. Well, I watched your show on Friday, as I do every day, and you said stay positive on good U.S. businesses, even if they're going through tough times. In that context, what's a more American business than Disney? The revenge travel is going to come back this summer. We heard from Target on the earnings call. Their top sellers were suitcases and bathing suits. The number one destination is going to be Disney, and you can buy it at a 32% discount off its 52-week highs. They're going to grow earnings at 29% next year, double earnings over the next 4 to 5 years. They added 12 million subscribers to Disney Plus in the last quarter, taking their total subscribers of Disney Plus, Hulu, and ESPN to over 200 million. We continue to be bullish on America and on Mickey Mouse. Well,
30% cheaper. Exactly. This is precisely the time. Maybe even yesterday or the day before was precisely the time. But Teddy, the markets have shown they can deal with what we're looking at the moment, and that is a rising rate environment. But they were coddled and warned and stroked well ahead of time. Hey, everybody, this is coming. But what worries you in this atmosphere?
Well, what worries me, Liz, is that the Fed, though they don't admit it publicly, clearly has been behind the curve when it comes to inflation. And I think that the relief today is that it wasn't 50 basis points, but only 25, which they telegraphed. But he also said if they had to be more aggressive, at least that's what I heard, going forward, depending on what inflation does, they could be. I think the inflation trade is still with us. I don't think anything has really changed. I think investors need to gravitate to the financials, to the insurance stocks, to the energy stocks, to some of the commodity sectors, to be in areas that can take advantage of inflation, because it's going to take, at least as we heard today, at least 1 year and possibly 2 years for the Fed to get comfortable and get the inflation genie back in the bottle. And it's going to be a lot harder, I think, than the Fed and everybody else thinks.
Well, Dow is up just under 300 points at the moment. I don't know. Look at if we can show 3-year charts, precisely to your point. You guys are all, okay, the markets have been scary over the past month or so. Over 3 years, the Dow is up 31%. The S&P up 53%. The NASDAQ up 73%. And I believe the transports were up crazy. That's NASDAQ 100 up 89% over 3 years. And this just shows that people have been not necessarily forced, but they've been pushed to find yield in the stock market because treasuries were simply not doing it. And I think, Tom, that it's time to kind of turn down the heat on some of this, and the Fed is realizing this now. So are there any other areas that you think are poised to race higher?
Well, believe it or not, if you look back at the data, Liz, over the last 4 hiking cycles, cyclicals, banks, energy, materials actually outperform in the 6 months up to the first rate hike. And after the first rate hike, in the following 6 months, the top 2 performing sectors, which is counterintuitive, are REITs and technology. And everybody has been dumping technology hand over fist. And we think there may be some opportunity in some of these beaten down tech stocks. It's contrarian, it's counterintuitive. But when you look at how far Facebook has fallen, some of these high quality businesses, even the value tech like Intel, et cetera, there may be opportunity here for some bargain hunters.
Oh, well, yes. And we've been trying to say that the time to go in is when there is the most fear. Today, we're not seeing that. We've got Meta, Amazon, Alphabet, Apple, all moving higher. Apple seeing a 2% gain here. Teddy, what are your picks?
Well, it comes back to the financials. I mean, I like some of the big banks like Bank America, and I think Charles Schwab is a terrific way to play higher interest rates. Some of the energy names, Occidental Petroleum. I like the exchanges because of all the built-in volatility we seem to be experiencing, and they take advantage of that. Something like Intercontinental Exchange, ICE. There are a lot of places to go, Liz, I think, other than where we have been for the last 4 or 5 years in terms of what has carried the heavy water for the stock market. But you know what, Liz, if you go back to the spring of 2009, the Dow was 6,600. And here we are at Dow 33,000. The market has had an enormous move on the backs of easy money. The easy money is off the table. It does not speak well, in my opinion, for the overall market. I think you got to get really cautious and be really specific. There are good things to do here, but it's not going to be a rising tide floating all the ships.
Teddy, Tom, I'll tell you something. Easy Street, as we said at the top of this show, Easy Street is over if you're talking about borrowing money. Thank you both so much. You want to see a complete turnaround, you guys? Fox Business Alert, foreign listed shares of Chinese